Well, hello, everyone, and thanks again for joining us here today at Or Day. It is my sincere honor to be able to introduce David Rosenberg. David, of course, is a world renowned economist and really a bit of a Canadian icon. And he's been voicing his opinion of late about all sorts of things, but particularly buying things which are scarce. And of course, that relates close not just to gold, but many things that are near and dear to our heart here at the Or Group. So, without further ado, I'm going to introduce David, and I'm really looking forward to hearing what he has to say on this very strange and unique economic times we are in. So, please, Mr. Rosenberg.
Well, thanks very much, and good morning, everybody. And I want to say at the outset, just to wish everyone a COVID-free and vaccine-filled 2021. Maybe 21 is going to prove to be lucky, but I do have to say that I'm not nearly as optimistic as most of my economic and strategy compatriots are at the moment. That doesn't mean that there aren't any opportunities to make money. And I would be the first to say that if equities and corporate credit, and dare I say commodities, the risk on trade in general, if they can all have the year they did in 2020, with so much human misery, 84 million global virus cases, 1.8 million deaths around the world. I suppose even if you're the most ardent bear, you've got to say anything is possible. From my perspective, there's only one bear market in 2020, and the bear market in 2020 was in rational thought, prudent investing, and the pricing of risk. If you're rational in thought, if you're deep into analysis, if you're focused on risk-adjusted returns, capital preservation, this is no market for you. The real bull market is this belief that equities don't go down and have somehow morphed into riskless assets because central banks will always be there, didn't you know, to support your portfolio. So throwing caution to the wind has become the name of the investing game. The perspective of assessing future corporate cash flows, undertaking proper valuations of that residual claim has really proven in the past 9 months to be nothing but a waste of time. It's not always going to be like this, and investors yearning for mean reverting themes, I think, should have to recognize that we'll look back on this period of time as being in a huge financial bubble. A year that saw IPO volume swell to a record $435 billion. We took out the prior bubble in 1999 on that score. The average one-day surge in IPO prices in the past year, plus 40%. Again, the highest since 1999 tech bubble craze, and we know what happened next. 240 SPACs going public, trading on average 15% above their offering prices. We have companies like Tesla being valued more than the rest of the auto sector combined. And then you have Airbnb somehow being valued by today's investor at more than the rest of the hotel sector. Are developments that we'd have to say are completely beyond normal. And this sort of behavior, by the way, cannot be explained alone by interest rates or liquidity. Any historian will tell you it's being driven by speculation and momentum. And it's the same market, keep in mind, this is the same market that we saw back in the spring that investors began to buy Hertz's stock after the company declared bankruptcy. Have we ever seen that before? And now we have 20% of the members of the S&P 500 are now officially Japanese-like zombies, in that their internally generated cash flows aren't enough to cover their interest obligations, but you see they are being kept alive by Federal Reserve policy. And don't get me started on Bitcoin, which is in a massive price and sentiment mania of its own. And like most other things, is trading where it's trading because we are in a gigantic, unprecedented global liquidity bubble. And this is the environment we're compelled to invest in. We had the worst recession, and whether it's endogenous or exogenous, it's immaterial. We had the worst recession since the 1930s. And even with the recovery that we've had since early summer, employment in the United States is still down 6% from where it was a year ago, but personal incomes are up 4% because we've had this ongoing massive expansion in government transfers. And of course, under the Biden administration, that income transfer is going to be ongoing. So we actually have a situation where personal income in the United States, because of all the handouts from Uncle Sam, and maybe this is just a matter of morality, as Joe Biden said last night in his address. This is a matter of moral obligation. But here's the reality: personal incomes in the United States are actually $500 billion higher, or 2.5% higher with the pandemic than without the pandemic. So it goes to show you that not only has the US government and the Canadian government filled a massive hole, they've overfilled it. Incomes are $500 billion more with the pandemic than without the pandemic, and you really can't make this stuff up. And then you go to the stock market, and we lost almost 3 years worth of profit growth. We've lost about 3 years worth of economic growth. But then what happens is the Fed cuts rates to zero. It massively expands its balance sheet by 75%. And the power of that multiple expansion due to that unbelievable liquidity spurt means that the S&P 500 is actually trading 20% higher today than it would have been had the pandemic never happened. So without the pandemic, and I've done the work on this, we'd be at 3,200 on the S&P today, not 3,800. So the bull market and risk assets, I'll say, the charts don't lie. It's fully intact. But I think we should be honest with each other and acknowledge that we are in a financial bubble of historical proportions. At least it's useful to know the environment we are compelled to invest in. Now, I talked about the stock market, but how about the bond market? Now that we have over $17 trillion of bonds globally trading with a negative yield, the average bond yield in the developed world is zero. 3/4 of the government bond market actually trades with a negative yield, mostly in Europe and, of course, Japan. But you look over at Europe and you start thinking, how is it possible that a 10-year Portuguese bond can go negative, as it did in recent months for a triple B rated credit? Spain, yields there negative with a credit rating that's borderline investment grade. The yield on 5-year Greek debt is almost at zero. The front end of the Greek yield curve, could you believe this? Could you sold the story a decade ago? The front end of the U.S. of the Greek yield curve is trading in negative territory for a double B minus credit junk bond rating. And then recently, if you're paying attention to what's happening in other parts of the markets beyond commodities, and we're looking here at the credit markets, I mean, come on. We just had Peru, a triple B rated sovereign, managed to float a century bond, a 100-year bond with a 3.3% yield. Who's buying this stuff? A near junk emerging market piece of long duration paper sold at a 170 basis point premium to the long US Treasury bond. And then more recently, the Ivory Coast issued a 10-year bond, massively oversubscribed with a 5 handle, while the country is still in an IMF program. And then you go to the US, and you'll see that we now have a record number of companies that are rated triple C, which is distress or worse because of last year's massive debt explosion. And yet these are the bonds that, if you're an investor, made you a killing this past year. We have a situation where the average yield of a 1 to 3 year piece of corporate paper today offers no premium at all over agency debt, which has a federal guarantee. And you have to ask yourself the question, why? And the answer is because of the Fed, because the mere threat that the Fed can come in at any time now under the Powell administration and buy risk is credible enough for investors to sit back, relax, do very little work, and just know that the Fed is going to continue to blur the line of what is inherently risky and deserves a wider risk premium and what is not. That is the insane world that we have to wake up to every single day to invest in. A world where high yield at a crazy 4.5% average interest rate is neither high nor is it yield. So this is what happens in this situation is what we're seeing in the riskiest tranches of the debt markets. When, as an investor, you believe the central bank is going to backstop your holdings of the junkiest corporate bonds, what happens is that the discount rate you normally use in your DCF analysis, that converges on the risk-free rate, which is zero. So the equity risk premium gets destroyed in this process. And along with that, any necessity for any investor to have to deploy the capital asset pricing model, which was the cornerstone for investing for decades under the tutelage of Harry Markowitz, who won a Nobel Prize on that model. So we have in our hands a backdrop promoted by Jay Powell, where investors are continuously forced to move out of their comfort zone and natural habitat to the riskiest segments of the investment spectrum. So historians won't just be writing about the human misery of 2020 and 2021, but they'll also be writing about how central bankers blew bubbles everywhere in the name of promoting asset inflation and investor animal spirits, and leaving in its wake further extremes in income and wealth inequality with unknown future social instability consequences, which is why I say you might not want to trim your gold position too quickly. Meanwhile, I keep hearing how strong the fundamentals are in the United States. Seriously, a fiscal deficit of 15% of GDP that Joe Biden will clearly take above 20% of GDP, a Fed balance sheet over 30% of GDP, and as I said earlier, we have 20% of the S&P 500 littered with Japanese-like zombie companies. The US dollar has been slip sliding away, so I say to that, sure thing, solid fundamentals. Meanwhile, 1 in 20 American homeowners are now in some form of mortgage loan forbearance. We have 1 in 15 of all mortgage loans are delinquent. These are the sorts of things, again, that Joe Biden was talking about just last night. These are all double where they were a year ago. We have a situation where 16 million Americans reported recently that they had not worked a day in the previous week and that they're relying on federal and state assistance to make ends meet, and that 25% of the public is now dipping into savings or selling off assets to meet their spending needs. We have almost 20 million American workers on some sort of benefit plan. And all of a sudden, what do we find out? That $900 billion of fiscal stimulus isn't big enough. We need an extra $1.9 trillion. So folks, this is why I have continued to say that we are in some form of economic depression. And I'm not really that convinced that vaccines are going to change that assessment. But in a narrow view, what are the markets telling us? The markets are telling us that the new normal is going to be some reversion to the mean, where life is going to go back to normal. I say to that, not so fast. Now, there's no doubt in the world that people are going to go back to restaurants, hotels, airplane travel in due course, but don't think for a second that there will not be residual impacts. The narrative emerging from the recent trading action in the equity markets tells us that we are somehow going to go back to our old lifestyles. And actually, that's what I would bet heavily against. I have seen, and I continue to see, secular shifts in behavior that I believe is going to transcend a couple of quarters of what everybody calls a pent-up demand release in the consumer services industry. From my perspective, what I expect to see is a permanently higher equilibrium personal savings rate and a permanently lower labor force participation rate in terms of the secular change we're going to be seeing coming out of this pandemic. And think about what it means to say that we're going to revert to the old normal, which of course everybody seems to talk about. Just remember what that old normal was. What was the old normal? What was that prior 10-year period before the pandemic? It was one of low growth, low inflation, and low interest rates. And I don't see that changing because of the secular forces of aging demographics, massive debt burdens. What I said earlier were extreme income and wealth inequalities. And all these things, if anything, have become accentuated by the pandemic. And at some point in 2021, What I see is I see the market at some point being forced to switch from just pricing in the light at the end of the COVID tunnel to a life is going to be like once we get past that light. And I doubt it's going to be a very smooth ride because at some point we're going to have to confront and resolve these massive deficits and debts that have been built up during the pandemic. Something we didn't have to contend with in the 1918-1919 Spanish flu because the government didn't provide fiscal handouts. So we went into the roaring 20s with a 10% debt to GDP ratio, not 120%. It was clearly a different, you can say, and less generous society back then. But that solid fiscal position, that we had at that point actually allowed the government to cut taxes perennially in the 1920s, both on the personal side and on the business side. That's how we got the roaring 20s. So anyone telling you about the roaring 20s today as it means for the future, I can only say are in a dire need of a history lesson. Now, a major point that I need to emphasize is that it can't possibly be lost on anyone that what we had on our hands was a health crisis, morphed into an economic crisis, and then somehow morphed into a financial crisis that was 10 times worse than anything we saw in the great financial crisis. And it forced the Fed to ride the cavalry in and probe the outer limits of monetary intervention. So the vaccination process is no reason to believe that we're not in some form of economic depression that's only been disguised by the unprecedented policy stimulus. The New Deal in the 1930s did not cause the Great Depression to end. It created a lot of spending, but the Great Depression didn't end until World War II. So I would say that just because your kid has training wheels doesn't mean that he or she knows how to ride the bike. And this economy globally, outside of China, which I'll get to later, has training wheels. We have an economy in our hands, both Canada and the United States, that can't seem to survive without large-scale deficit finance and central banks acting as though they're hedge fund managers. And so this is why I'm saying it's a form of economic depression. And also because what comes next after a shock of this magnitude is a secular change in attitudes towards credit and towards savings. I mean, seriously, over half of the households in North America didn't have enough cash on hand to even get through 3 months of a job loss. And this is not going to be lost on anyone right now that's getting by on government benefits. And what's most interesting to me is what the household sector has been doing with all this government stimulus over the course of the past several months. The researchers at the New York Fed have already provided a report based on a survey and found that 2/3 of what's called stimulus, but it's really income transfer, has gone into savings or to paying down debt. And the surveys are also finding that people are more likely to save and pay down debt in this upcoming round of stimulus. And if you look at the recent polling data, and we saw this from CIBC very recently, the top priority for households this year is going to be balance sheet repair and bolstered savings, not lining up at the airport or booking restaurant reservations. That will come, but I think that the pickup is going to be rather disappointing and not have a lot of legs from a duration standpoint. What I'll say is that what the world looks like when this crisis ends for good, we'd have to admit we're in a bog. It's really anybody's guess. But I will say with 100% clarity that it is going to look different than it did before. And I sense that some of the structural changes in the economy could be long lasting. Global supply chains could shrink. In some cases, we could see the full repatriation of manufacturing in certain industries. By the way, that's a veiled pledge in the Biden pre-election campaign plank. And that would have an influence on pharmaceuticals, food, high tech like semiconductors, really areas that are deemed to be in the realm of national security. Before the pandemic, the emphasis was on just-in-time production for decades, with parts being delivered just when they were needed in the manufacturing process. In the post-pandemic period, I think that the emphasis is going to shift to some extent to just in case supply chains, not just in time supply chains. And they're going to emphasize two things: proximity and certainty of delivery. Uh, and then beyond the question over government policy, we have to consider at the individual level how months of isolation and social distancing, and in the future, the extent to which we're going to have concerns over the mutation of the pandemic, how these will fundamentally alter lifestyles, and I think have a profound influence not just on the way we live, but on how we conduct ourselves in our personal and our business lives. And then we have to consider, when we get to the other side, these massive government debts that have been built up, and how that, along with even more bloated central bank balance sheets, how are these going to get dealt with? Will these debts get monetized or not? Or, God forbid, will taxes have to go up on the middle class? Just some things to contemplate in 2021 as we get those booster shots and then race to the local brasserie. The stock market is not the economy, so don't believe for a second that these record high equity prices means that the road ahead for everybody else is going to be that smooth. At the same time, I'm absolutely emphatic that this work from home theme, where I am right now, working from home, this is not going away. The surveys, again, are saying the very same thing. We just got one from PwC, found that 72% of the workforce want to work from home at least 2 days a week once the pandemic is over. That share was 5% before the pandemic, by way of comparison. And as Fed Chairman Jay Powell said a few months ago, and this is one thing I agree with him on, he said in quotes, "We're recovering, but to a different economy." And I say he's right. So look, we may get to normal if that's what you believe, but it's going to be a new normal. So coming out of the pandemic, these are some of the secular themes I see emerging. I see that we're going to go into an era of elevated personal savings rates, where people are going to focus on what they need, not what they want. So anything related to e-commerce, cloud services, wiring up your home to become your office, that is in a budding new secular growth phase. Delivery services have become essential here. So there's another budding bull market right there for Amazon, which is so obvious, and any business model that copies it. I could tack on grocery chains with online services, come out of this as a big long-term winner. So the shifting behavior that's already taking place tells me to focus on consumer staples and other areas of the market, I'd say even healthcare and big tech, that have become essentials. Microsoft has become a utility. I'd say one could argue that Amazon has become a utility, and perhaps even with all the regulatory risk, Google has been re-rated as a utility. And it's apparent to me that you want to have exposure to healthcare because this clearly is an underinvested area of the economy without a shadow of a doubt. And I actually think no matter that the Democrats are in power, is a sector that's going to become less regulated over time. So to reiterate, I think that any investment strategy preparing for the new normal should emphasize that work at home, remote lifestyles, 5G, cloud computing will all continue to favor big cap tech, utility, or essential characteristics. Though, as I've said before, I prefer to pick up these plays at better prices than we have today. There's a big debate about growth versus value, stock market decision making. I would say a lot of that obviously depends on what the world looks like once COVID-19 is in the rearview mirror. But I will continue to stress that even with a vaccine, when you consider that even if we return to the pre-COVID world, think about what that means. It means a return to what defined the previous 10 years: slow growth, low interest rates, low inflation, which means that actually growth will remain the place to be because these are the longest duration stocks in the equity market. For most cyclicals and value stocks to work, you need recurring, accelerating economic growth. You do need to have that inflation come back on a sustained basis, and you need a permanent increase in interest rates. Now, look, there's been a move recently in that direction, and there's been flows into the value trade, and it does actually make sense since these stocks, along with most of the basic material space, have been dirt cheap and deserve to be re-rated positively. for the post-pandemic world and the initial recovery phase. But at the root, a lot of this is really just a mean reversion trade on valuations. I would say it does have more legs attached to it, but that's why it's referred to as the value trade and not the value trend. For the same reasons why value underperformed growth 80% of the time over that 2009 to 2019 bull market expansion. But instead of leaving off on a somber note when it comes to the economic outlook, and remembering constantly that we are living in a historic financial bubble, what I'm going to do now, and was mentioned at the beginning, is to come up with a sane investment strategy for an insane global marketplace. So what I'm going to do is lean on the classic scholarly works of two of my heroes from the past, Adam Smith and David Ricardo, and focus on what is otherwise known as scarcity value. Own what is scarce, do not own what is abundant. So as I said before, growth is scarce, which is why I want growth stocks in the portfolio, especially once the mean reversion trade to value runs its course. That means big tech, but with utility-like characteristics, brand name consumer staples, and healthcare. What else is scarce? Well, I mentioned before that we have $17 trillion of global bonds trading with a negative yield. So I want income. Income is scarce. That means that dividend yields, dividend growth, payout ratios, all the more important. I'm thinking here about the Canadian banks, telecom, pipelines, select REITs with quality tenants on the residential side, but in general, assets that spin off a reliable income stream. The third scarce resource is safety. What is safe in your asset mix? And I always get guffaws when I mention the necessity of having a substantial portion of the portfolio in long duration, high quality bonds. And I say yes, even at today's low yields. And I'm not talking about Japanese bonds. I'm not talking about European bonds. I'm not talking about Canadian bonds. I'm talking about US long bonds. A 1.85% yield in the long US Treasury is an absolute giant in a world where 30-year German bonds are negative 15 basis points, JGBs are 60 basis points, UK gilts are 90 basis points. The US long Treasury in the realm of government bonds is trading like a high yield. It is rated AAA and is the most liquid instrument on the planet. But to people that say, well, why would I own bonds with such a stupid low yield? I say to those people, just ignore them. Yes, yields are low because as a price, the bond market is also telling you that we're heading into a future of ultra low expected returns. It's no different than what the expected return is in the equity market with a CAPE PE multiple of around 35. The rates market is telling you we are going into a future of ultra low expected returns. And so here's the major point. The major point here is this. The equity market has actually lost you money over a 5-year interval, no less than 12% of the time in the past 5 decades. The treasury market has never once lost you money in a total return basis over a 5-year interval. That's the difference. So I look at bonds as a ballast, as a stabilizer in the portfolio at all times. Is there inflation risk in treasuries? Yes. Is there duration risk in long treasuries? Yes. But what makes treasuries, what makes them unique above all other asset classes, including commodities, is their payment safety characteristics. They are the only assets where security and certainty of payment is assured and guaranteed. Treasuries are the only investment vehicle with no default risk, no call risk, no reinvestment risk. So they are the only thing you can buy where you know exactly how much money you will have 30 years from now. And in an uncertain world, that certainty carries with it a lot of allure from my perspective. So let's get into the fourth and final item that is scarce, which is what I call inexpensive assets. Since everything is off the charts expensive now, that central banks have all but destroyed the equity risk premium, as I said earlier. But you see, there are faraway places like China and Southeast Asia where assets are still cheap, where price earnings multiples are in the low teens, and a region that has emerged in much better shape, both economically and financially, coming out of the pandemic. They're capturing an ever larger share of global GDP, to which I conclude, for the benefit of investors who can invest globally, my theme has been for months now, go east, young man and young woman, which then takes me to China in particular. Now, it may have started the pandemic. Some believe that China did it on purpose, but I won't go there. But we do know that Beijing was secretive, to be sure. And we know that transparency is definitely not part of their political culture. But let's look instead of economic facts instead of political opinion, which is that China was the first to kibosh the virus. It was the first to have its economy reopen. And while the rest of the world, while global GDP in 2020 contracted 4.2%, what did China GDP do? Up 2%. And it's poised to actually expand 8% in 2021. China's economy is poised to expand 8% in 2021. And its share of global GDP, it just hit a modern day record of 14.5%. China's share of global GDP is going up 150 basis points a year. And I sense that that trend is going to accelerate because the country is one of the few that did not blow its brains out on negative interest rates, quantitative easing, and massive fiscal deficits. Their budgetary situation is actually in much better shape on a comparative basis than it is in most countries in the developed world. So none of that intervention happened like it has in the US and Canada, which tells me as an economist that China has fewer constraints on its macroeconomic future. I hear all the time about how China's population is now in the decline, and that's true, but every inch of its growth is coming from productivity. And that productivity is coming from years of major capital deepening and infrastructure investments, something that is only now being discussed in the United States with the Biden administration. Think about it, fully 12 years after the last infrastructure spending package by Barack Obama, all the way back in 2009. Now, I say all this because I am bullish on Asia. And for everyone on the call, it is Asia that remains the marginal buyer of commodities. All the correlations on demand run through Asia and principally China. And in fact, for most of the base metals, half of the world's consumption still comes from China. And this is where we have tremendous visibility for the coming year and perhaps the coming years. We're already in a bull market in the metals. We're facing acute supply constraints, but Chinese demand will continue to bump against these constraints. And that tells me that we're only probably halfway through this bull market in the resource sector that began a little more than 8 months ago. Keep in mind that for the metals sector, and it's in a bull market, the year-over-year price growth typically peaks out at 50%. We're right now at 23%. So we're closing here on a positive, and we're looking at history of these sorts of cycles. It's telling me that despite my overall caution, this is one area that has visibility and has room to run in the resource sector, coming off that bottom that we had last spring. So once again, 50% year-over-year growth in pricing is a traditional peak. We're barely more than 20% right now. So we're just not even quite at the halfway point. That's really the bullish story coming out of this. I'm a little out of breath, so I'll leave it there and entertain any questions that you may have. Thank you.
Well, thank you very much, David. That was certainly very interesting. I certainly agree with plenty of what you had to say. And I'll start my first question off where you left off, and that's China. And I would have been 12 months ago, I would have been in complete agreement. But two things give me caution about China and their growth. And the first has to do with your comments on COVID and how that's changed our behavior. Are you not concerned about the general perception of how China may have caused this and potential liabilities that may result, lawsuits, et cetera, that follow? And the second thing that concerns me about China is the increased rhetoric and complaints I hear about their human rights abuses, and whether that may lead to sanctions, and whether that ultimately may lead to another Cold War. What are your thoughts on that?
Well, I mean, here's the way I see the situation. I don't know so much about lawsuits or who's going to be able to collect money from Beijing. I guess, good luck. The point about sanctions, they've been tried. I think that at this point, China has become such an integral part of the global economy. You're going to put sanctions on China, which everybody relies on as a consumer. China is no longer just a producer. It's also the world's largest consumer. So you're going to cut off your nose to spite your face. Look, the die has been cast. Whoever was in charge 20 years ago decided to let China into WTO with all their environmental practices and their labor practices. We should have really had that all redressed ahead of time. That was 20 years ago. The die's cast. Well, what are you going to do about China? The Trump administration had a chance to bottle China up and isolate it if they signed TPP back when Trump took over in 2016. Trump decided to walk away from TPP. That would have isolated China. But Donald Trump wanted to go bilateral and not multilateral. So what just happened? What just happened in the past few weeks? China signed on to a trade agreement with 14 other Asian countries. China is going to become an even more important consumer and producer, and these other countries throughout Southeast Asia are going to become ever more important supply hubs for the Chinese economy. China just inked an investment deal with Europe. So China is actually doing deals. For all the talk about sanctions, this is obviously not things America's happy about, but other parts of the world are doing deals with China. It doesn't get reported that much. Look at through the Silk Road that they established years ago. Look at the toehold that China has now in Africa. Have you heard anybody in the United States talking about Africa? I mean, we're talking here at the OR conference. Africa. Think of all the resources that. Of course, it's a lot of political dynamite in Africa. But you tell me, has the U.S. been forging ties with Africa, or has it been China through the Silk Road? So yeah, I don't disagree with anything. China is a pretty scary place. I think primarily to live. But I'm finding it very interesting that as all these other countries in the world, led by the United States, look, we've already had a central bank intervene to influence and distort asset prices, coming in to buy high yield bonds, promulgating zombie companies. And now we have the Democrats. Now it's not a blue wave, it's more like a blue ripple, but they are in charge. And they ran on income redistribution, which I think is necessary for social stability purposes of anything else. But you see what's happening in the US, deficit after deficit after deficit, more stimulus. It's interesting, and you're seeing this in Canada. The United States, think about it. It's supposed to be the Wild West. It was supposed to be, you expected the US to have all these massive dispersions because you want to reach for the top. The United States is heading towards a universal basic income, which so I'm just going to say, who's becoming more like Europe? Europe's already turned into Japan. Now the US is on its way to Europe, on the way to Japan, and the country that's becoming more capitalistic, the country that actually has a positive interest rate, is the communist country that discovered money, and it's called China. So irrespective of all the other concerns that you're mentioning, China is well poised. I'll just tell you right now, when you look and see the infrastructure investments they've made in the past 10 years, the capital deepening, do you see what happened in North America in those past 10 years? People confused a strong stock market with a strong economy. It was the biggest debt for equity swap of all time. Corporate debt went wild in that last cycle from 2009 to 2019. So
corporate America, corporate Canada borrowed en masse. Oh, but not to fund capital expenditure. There was no capital deepening. Look at productivity growth in North America. It's putrid because businesses borrowed money, bought back their stock, created this apparent boom in earnings per share, which was a bit of an illusion. And then you get a huge bull market rally in the context of the weakest economic expansion in the post-World War II period. But you see, China, and it's a different economy, and you can argue it's a command economy, but their infrastructure spending has been incredible, and they're getting the productivity payback. Every inch of GDP growth in China is coming from productivity. So I think that somehow I would want to invest in that. Now, derivatively, if you are bullish on China, and remember the way when people ask me, how do you invest around China? It's not as if China didn't have all these human rights abuses back in the 2000s. In the 2000s, we had two things going on. We had the mortgage insanity in the United States and the big housing bubble, but then we had what was happening, China's ascendancy in the global economic scene, and we had a super cycle in commodities. Now, I'm not going to say we're having that sort of, I'm not saying oil's going back above $100, and we are gravitating increasingly towards a more service sector economy globally. But I think we're in a mini boom on the commodity cycle. And I think a lot of that is coming from Chinese growth. Am I worried about lawsuits? Am I worried about, that there's going to be factions that, that are going to be calling for China for sanctions on China? I just don't think they're going to live to see the light of day. I mean, look at Donald Trump. Who was tougher? Look how tough Trump was on Canada, and look how tough he was even on Europe. But when it came to China, China went tit for tat. China went tit for tat with Trump, right? You're going to push China around. Did Trump, Trump is a pretty tough guy, was he really successful in pushing China around? In the end, what did they get with the Phase 1 trade deal? What did they get? They got the farmers to sell more soybeans and agricultural products into China. By the way, China needs those, especially given how many pigs they had to cull in 2019. They needed that. So you're telling me that somehow other factions around the world are going to push China into a corner that Donald Trump couldn't do? I say to that, good luck.
So you're absolutely right. China has become a voracious consumer of commodities, and every mining company out there views them as a buyer. But anyways, let's shift gears and go towards what Joe Biden just announced very recently. He's and you noted it with their $1.9 trillion stimulus package, and to my mind, what prevents that from turning into $19 billion or more? How are they gonna turn off the taps? Can they turn off the taps?
Well, look, and it's 1.9 trillion on top of the 900 billion that just got passed. Now, look, he's talking about 1.9 trillion. Are we supposed to sit here and assume he's going to get 1.9 trillion? It's a 50-50 draw in the Senate, and Kamala Harris has the tie-breaking vote. That much is true. But I said it's not a blue wave; it's a blue ripple, and not every Democrat, and especially Joe Manchin from West Virginia, which is a very conservative state, not every Democrat is Elizabeth Warren. Okay, so we'll see. Look, for them to get this done quickly, he needs 60 votes in the Senate. Okay, so to get by a filibuster, they have to go through the reconciliation process. Just like Trump did on his tax cuts. That didn't take overnight. So I don't think a bipartisan bill is going to mean we're getting 1.9 trillion. I think what Biden did was introduce his wish list. But you can come back and say, well, let's say they get half of that. Let's say they get another 900 billion. I mean, those are huge numbers. Even 900 billion in a $2 trillion economy is, you're talking about almost, a huge amount, 5-6% of GDP on top of 5-6% of GDP. But the reality is that they don't have the mandate to do a whole lot more. I think this might be, unless actually the economy continues to deteriorate If you know, a lot of this is situational based on what happens between the race between the virus and the vaccine. There was bipartisan support for the first round that we just got in December. I think there's less now than there was then, but they'll get something done. We know they'll get something done. And your question is, you know, at what point will it end? I mean, who knows? I guess that, you know, the view is that the bond market's not blowing up. Then again, you have the Fed financing a lot of this stuff. I said before, we're turning into Japan. Look at Japan's debt ratio. Now you'll say, well, okay, things are pretty stable in Japan. Yeah, I get that. You know, with their gargantuan, and look, the Bank of Japan owns 100% of the JGB market. Okay, look, if that's a sort of, I mean, their stock market's done fine, but it's still 30% below where it was at its previous peak. But do we want to become Japan? Because what's happened is that you still have to pay off that principal, even if interest rates are low. That debt morass still acts as a constraint on aggregate demand. So if these recurring rounds of fiscal stimulus was really the road towards prosperity, Japan would have been in a boom mode for the past 2 decades. It's been one of the weakest economies in the world. So I guess that's where we're headed. I guess you could say, yeah, okay, we'll trade that in. We're gonna have more stability and much slower economic growth. Well, that's been the Japanese model for the past 20 to 30 years.
So how does this all play into gold? You've been on the record about a year ago. You said you see gold going to 3,000. What's your opinion? I know you don't have a crystal ball, but give us an update on your view on gold.
Well, you know, I think that gold probably on a near-term basis is probably in a trading range. I think we have to respect the fact that we're in a really on a placeholder right now. The markets are telling you that, but this is after several years going from like 1,200 to 2,000. I mean, gold's been a great place to be. People tend to forget the gold price was up 20% last year. We only talk about the total return in the S&P, you know, being up 17, 18%. But you know, I think that we have this perception that Bitcoin is a challenger to gold. People who will show me the flows will say, well, take a look at these. And so, you know, and you're hearing just anecdotally, and I don't operate on anecdotes, I operate on facts. But it seems though these cryptos, which people believe that a means of payment has become a store of value, to me, that remains to be seen. But that has been an impediment to gold. I think without Bitcoin, and it's impossible to run models on this, but gold probably would be higher. So I guess you'd say there's a new kid in the block. That's a currency surrogate vis-a-vis fiat currencies. But I prefer gold to Bitcoin. I don't own Bitcoin. Gold is again, like treasuries, a ballast in the portfolio to me. I think that that if Asia is going to be a strong economy, and that includes India, and India and China are huge consumers of gold and jewelry, and we know that gold is very hard to get to. My sense is that over time, the supply demand dynamics, even with Bitcoin out there, and who knows where Bitcoin's going to be. I mean, it can move up or down 10 to 20% in a day. You know, I've never, you know, I don't think it's going to last as a classic investment alternative to gold. So I'm still very bullish on gold. That's an area where I'd be buying on dips. I wouldn't be surprised if we're flat for the year. If you're going to ask me, is gold still in a secular bull market where it's been now for the better part of the past decade? The conditions have not changed. Gold, like long treasuries, by the way, also delivered a 20% total return. These are insurance policies in your portfolio. I say that to all my clients. These, you know, you have an insurance policy on your home and you hope it doesn't burn down, but you still have the insurance policy. And the bond bullion barbell is what I call it, is an ongoing source of stability in the portfolio. You're not buying gold and not buying long bonds to make a killing. You're doing it to actually provide support to your portfolio when things go bad.
So I'd like your opinion on inflation, or maybe even deflation or stagflation. With all this printing we've seen going back to, you know, the first QE, we never saw runaway inflation, at least as measured by CPI. Is there a trigger you might see ahead that could cause inflation, or do we see deflation first? What are your thoughts?
Well, it's interesting. I talked about how the base metal prices from the lows are up more than 20%. And you'd say to me, well, how do we not have rampant inflation? Well, because as I said before, people aren't walking up and down the aisles of Walmart or Target looking for a pound of copper. I mean, this is we're not back in the days of Davy Crockett. This is a service sector driven economy. 20% of the core CPI is in goods and 60% of it is in services. Services are 3 times more important than goods are. So you can have goods inflation and you have service sector disinflation. And what comes out of the martini shaker is ongoing disinflation. So rents, for example, rents are the dominating feature. Rents. In fact, I mentioned Ricardo and Adam Smith. Go read about their classic works on the theory of rent. So the problem is that everybody focuses on their Bloomberg terminal and they see the CRB index and they look at the dollar and they say, well, there's got to be inflation around the corner. Well, no, sorry. The problem is that so many of these services aren't on your Bloomberg. You don't really know what's happening. And that's what dominates these indices. So rents are rapidly disinflating. That's going to continue for the next couple of years. We all know that the multifamily sector, we'll look at the commercial sector, there's going to be tremendous disarray. Rental inflation. And this is true. Yeah, people say, well, look at home prices. Yes, I get it. But housing is an investment. Rent is a flow of consumption. So we all admit that asset inflation is running rampant. Well, assets are not in a consumer price index. You don't, again, walk down Walmart or Target or Home Depot and there's a house where they're waiting for you. These are not assets. So, and this is one of the anomalies that we've seen all along, that as the central banks ongoingly try and get consumer inflation up, what they're doing is they're just getting asset inflation up and they're blowing more bubbles. And so I think there is something fundamentally wrong there. And maybe they're chasing the wrong metric. But what I'll say is that what dominates the consumption price indices are services. Rents are rapidly disinflation. Because enrollment rates have come way down, tuition rates in the United States, everybody complains to me about education, but yet when I show them the data, tuition rates are melting. Communication services melting. Internet services are melting. Now you have some other areas like delivery services that are accelerating, but service sector inflation is in a well-defined downtrend. And until that downtrend breaks, because it's so dominant in the price indices, inflation is going to go down even with base metals doing what they're doing. So, you mentioned before about the money supply. Yeah. I mean, we have M1 growth 60%, M2 growth 25%. These are rates of growth in the US money supply that would make people like Arthur Burns blush. But money velocity is going down at the same rate. Money velocity is going down the same rate. It's what I said earlier. Look what's happening with a lot of this stimulus. The stimulus is going to people to pay rent, to pay food, to pay utilities. And of course, they make no bones about the fact that it's not targeted. So it's going to go to other people too. Well, what do people do? People that don't need the money, what do they do with it? What do they do with it? Well, I guess you could say, well, a lot of them are renovating their kitchen, but come on, these checks aren't big enough to go renovate your kitchen and go build a pool in your backyard. The New York Fed survey I talked about before, a lot of the stimulus, it's interesting, it's going right back into savings and debt pay down. I mean, credit card balances in the US banking system are down to a 3-year low. I mean, how unpatriotic is that? But you see, that's what's happening here, is that if you're taking a look at the money supply, that's the liabilities of the banking system. Because of Fed policy, they're booming. But have you ever seen what's happening to bank assets, to credit? Credit's flat. Liabilities are skyrocketing. And so that excess is going into financial sector inflation, but it's not going into consumer price inflation. And inflation will come back at some point. But I'm amazed that it's become so topical, as if it's around the corner. It'll take years. There's still so much excess capacity in the economy. I mean, we have 1 in 12 American workers unemployed or underemployed. We have a 74% industry capacity utilization rate. The amount of excess supply relative to demand is way too high right now for me to be concerned about inflation. It's going to come at some point. I'm sure it will. It's like the boy who cried wolf. At some point, the wolf, the wolf showed up at the end of the story. But I still think the inflation story is years down the road. It's not happening this year.
Well, thank you, David. I've got one parting question for you, and it has to do with the potential of this bubble bursting, as you discuss. What are the odds, if we do see something calamitous, that there is some sort of reset, like a Bretton Woods? Is this financial system sound? Isn't it here to stay? Or what are the odds we could see some real fundamental changes?
Well, I guess I get asked the question specifically from my own clients about, will the U.S. lose its reserve currency status? And the problem is that there's no alternative to step into the plate. It's not as if there's a U.S. dollar to replace sterling, or sterling to replace, the guilder. It's not that simple. And I don't think the U.S. is going to lose its reserve currency hegemony anytime soon, even though China would be a rival. But I think you'd have to have some transparency and property rights for a currency to ultimately become a reserve currency. Maybe that'll happen in a lifetime. I'm not really sure. I think that it's still it's a work in progress. You've got a lot of these people, the modern monetary theorists, MMT, I call it the magical money tree. But people say to me, hey, look, Japan's been doing this for decades, adding more and more debt, adding more and more debt. Interest rates are low, adding more and more debt. And maybe this, the clown at the party will just continue to blow the balloon. And maybe this balloon never pops. You see, the thing is that it never did pop in Japan, did it? It never did pop in Japan. We have not as many years for data points in Europe. I mean, I don't know what blew up in Europe. I mean, if you bought Greek bonds last year, you made a killing. I mean, so I don't know. People say, well, look at the Japan experience. Okay, but the Japan experience, because the excessive debt is such a massive constraint on aggregate demand, they have no growth. Now, very stable society, but they've had no economic growth. And maybe that's where we're heading towards. So I don't know. You can build up all sorts of Armageddon scenarios, but what are we going to point to? The sample size is one. It's Japan, and their debt ratios are infinitely bigger than they are in the rest of the industrialized world. And have they blown up? Well, they haven't blown up. People come back and say to me, but they haven't blown up. And I'll say, you're right. But what they've got is very weak economic growth, and what has been historically weak rate of return on assets. Interest rates perennially at zero. So if you're a pensioner or you're a pension fund manager, it's been a fairly brutal existence. Maybe that's what we're getting into. But do you see what I'm saying? That's the best case scenario.
Okay, David. Well, look, let's leave it there. You've given us plenty to think about, lots of interesting thoughts. But I want to thank you sincerely for joining us here at Ord Day. You're very generous of your time, and I look forward to seeing you in person one day without masks.
Same. Thank you very much for inviting me.